Welcome to This Explainer. Today, we're diving into a genuinely fascinating case study in corporate resilience and pivot strategies, focusing on Verizon Communications. Back in August 2026, this telecom giant found itself caught in this massive, high-stakes balancing act. On one hand, they were dealing with some serious operational headaches and multi-million-dollar legal setbacks. But on the other hand, under CEO Dan Schulman, they were executing some incredibly aggressive, almost surprising strategic pivots to future-proof the business. We're going to unpack exactly how a company with 94 million postpaid users navigates this kind of turbulence and actually transforms those challenges into major opportunities. Here's our roadmap for today. We'll start with legal and operational hurdles, then move into restructuring and financial moves. After that, we'll cover community impact and relief, and we'll wrap things up with earnings and future outlook. All right, Section 1, Legal and Operational Hurdles. So let's take a look at how this specific legal drama actually unfolded over the past couple of years. Back in April 2024, the FCC dropped a huge hammer on major carriers, issuing a combined $196 million penalty. The core issue here? Carriers were essentially selling mobile users' real-time location data to aggregators, who were then turning around and reselling it without proper consent. Now, Verizon fought back hard, claiming the FCC deprived them of a jury trial, but the timeline just didn't work in their favor. By June 2026, the Supreme Court ruled 8-1 against the carriers. Verizon tried one absolute final appeal, basically arguing they paid under false pretenses, but on August 17th, the Supreme Court firmly rejected it, without even an explanation. $46.9 million. That's a huge number, right? And the kicker is, that is the final, completely unrecoverable penalty Verizon has to swallow. Now, while other carriers like AT&T are on a slightly different procedural track and might actually still fight to get their fines back, for Verizon, this multi-year legal battle over privacy is totally over. It's a very real financial consequence that directly hit their balance sheet this August. And man, the hits didn't stop in the courtroom. On Saturday, August 8th, a massive network outage hit major cities. We're talking Chicago, New York, Los Angeles, and Boston, with over 13,000 peak reports logged by Downdetector. And the worst part of all this? 87% of these reports were mobile phone issues. That means the vast majority of this outage hit everyday users directly, literally cutting off their lifeline to the world right in the middle of a busy weekend. Verizon actually issued a direct apology for this, stating that they know how much users rely on them. And the good news is that their engineers engaged super quickly and actually managed to fix the issue by 7:30 p.m. Eastern Time that very same day. But here's the thing. The exact cause of the outage, it remains completely undisclosed to the public. When you pair that with similar disruptions we saw across other carriers earlier in 2026, it for sure leaves some lingering questions about overall network reliability and transparency across the whole industry. Moving right along to Section 2, Restructuring and Financial Moves. To absorb these operational shocks, a key part of CEO Dan Schulman's strategy is aggressively slimming down the company's footprint. Over the summer, with the moves officially taking effect in mid-August, Verizon announced the sale of 274 company-owned retail locations and the elimination of 500 corporate jobs. So in total, this restructuring affects roughly 3,000 employees. Now, those retail locations aren't just vanishing into thin air. Rather, they are being sold off to franchise operators. This intentional slim-down leaves Verizon with exactly 1,000 corporate-owned stores, which leadership concluded is the absolute optimal number to execute their long-term strategic plan over the next 3 years. But here is the wild part. While they are aggressively cutting costs on one end, they are raising massive capital on the other, $3.75 billion. That is the sheer scale of Verizon's August 17th bond offering. And this wasn't some desperate scramble for cash either. It was a highly proactive, really strategic move. They are raising these billions to lock in long-term capital so they can keep investing heavily in their network infrastructure without completely wrecking their current balance sheet. Okay, let's demystify a bit of financial jargon to fully grasp this. What exactly is a hybrid bond? Well, it's a security featuring elements of both traditional debt, meaning it has fixed maturity dates and regular interest payments, and traditional equity, which gives the issuer the right to defer payments without defaulting. Verizon structured these specific notes, which are due way out in 2057 and 2059, precisely this way, to receive what's called equity credit from rating agencies. It's honestly a brilliant corporate maneuver to raise massive funds while keeping your credit profile perfectly healthy. Let's shift gears a bit. Section 3, Community Impact and Relief. In August, those awful, devastating wildfires tore through Spokane County, Washington. And during this crisis, Verizon really stepped up. They entirely waived domestic call, text, and data charges for both prepaid and postpaid consumers, as well as small businesses in the affected area, all the way through the end of the month. They eased that immediate financial burden, and they also paired this billing relief with a $25,000 direct donation to the Inovia Foundation's Wildfire Response Fund to help support emergency shelter and rebuilding efforts.
They didn't just stop at waiving fees, though. Verizon also deployed their Community Disaster Resilience Connectivity Van directly to Spokane to act as a mobile communication hub. We're talking free Wi-Fi, secure charging lockers so people don't lose their phones in the chaos, public access Chromebooks, and even document printing. And that last one, document printing, is absolutely vital for families urgently trying to print insurance claim forms right after losing their homes. It is real-world infrastructure right when it matters most.
All right, let's bring it all together. Section 4, Earnings and Future Outlook. There's a really fascinating financial dichotomy happening here. Total revenue actually dipped slightly by 0.7%, down to $34.3 billion. Why? Well, largely because consumers are holding on to their old phones way longer. Wireless equipment revenue dropped sharply. But despite that drop in revenue, adjusted EBITDA climbed 7.2% to a record $13.7 billion, and adjusted EPS is up 6.6%. Basically, by cutting costs, simplifying their offerings, and focusing heavily on the service side of the business, Verizon is pulling significantly more profit out of slightly less total revenue. And you can't deny their core service is growing. They saw 348,000 broadband net additions, but the real standout here is their 184,000 postpaid phone net additions. In a hyper-competitive telecom market, this actually represents Verizon's strongest consumer second quarter performance in 5 whole years. Now, how does this all build into their future? Well, look at this number. Over $1 billion. This is the massive figure attached to a landmark deal Verizon just announced with Google. They are going to provide dark fiber connectivity specifically for Google's data centers. So here is the big takeaway you need to remember. That Google deal is just the tip of the iceberg. Verizon is making a massive, aggressive pivot to become the foundational infrastructure for the booming artificial intelligence and data center markets. They expect to sign even more of these agreements with hyperscalers by the end of 2026. They are positioning their vast existing fiber network to be the physical backbone of the AI revolution, aiming to generate multiple billions in brand new revenue streams over the coming years. Which leaves us with a final, pretty provocative question. Is Verizon's aggressive pivot to AI infrastructure and corporate restructuring enough to overcome the friction of its operational hurdles? As a focused learner tracking this space, this is exactly the dynamic you've got to watch. The company is clearly in a massive transitional state right now. They offer a super robust dividend yield of 5.78%, but they're also constantly navigating these fine rejections and sudden network outages. They're balancing immediate, tangible challenges with massive futuristic bets on AI. Thank you so much for joining me on this explainer, and I can't wait to explore our next topic with you soon.